Good afternoon. This is Tom Aspray with the Viper Report. It's Wednesday, January 27th, about 1:30 p.m., half an hour before the FOMC announcement. It's been a pretty rough day. You can see the stock market. This is a hourly chart of the S&P futures. Started to drift lower. I first checked on, they were down about 16, then they were down about 26, and then they were down about 46. And you can see we actually got down, to 3760 below the Stark band here. High risk sell, low risk buy. We bounced. We got back down there again. We're trying to rebound from there. As I mentioned at the start of the week, I featured a similar chart. The MACDs were negative at that point, and they looked pretty sick. And they suggested that the path of least resistance was probably down. This is a daily chart of the SPY. It tracks the S&P 500. You can see we're trading well off the lows. They had a low of 375.63. Right now we're at 378. So that's a good sign. The monthly pivot here, I talked about pivots quite a bit in my presentation last week for well 365. That could certainly be tested depending on how we close. As of yesterday's close, there were a lot of warning signs, so I was not really surprised by the overnight action. You can see the S&P 500 AD line has dropped below its moving average here, has major support down in here. Stocks only AD line also closed below its moving average last night's close. Both of these have not been updated, and they will get considerably worse with today's act. You can see right now the breadth has improved, 792 up, 2407 down. Early in the day, about an hour in, we were like 555 up and 2,500 down. Still solid losses. S&P down 140, Dow and Nasdaq Composite both down 1%. The Russell down less. It's holding up better, so that's a good sign. And of course, the main story today has been GameStop, the crazy short squeeze. I do talk about short interest, and it's a variable I use in looking at stocks, but would not be getting in here unless you have money you're willing to lose, because it's going to be treacherous. Unlikely these gains are sustainable, but no one knows when it's going to be over. Stocks have had a great run since early November when they broke out of this flag formation, lines A and lines B, and the upside targets from this were in the, as I mentioned at the time, we're like in the 380 to 390 area. So we've had a high of 385, so we're getting up to that target zone. You can see we exceeded the monthly R2 resistance this week, and we're trading below it at this stage. So if you missed out on this move, how can you learn from that experience? Well, if you look maybe back in your email, you'll, under post-election, you'll probably see my email of November 6th, in that I discussed how the weekly AD lines were positive. They were positive before the election. They have a pretty good record, and I wrote an article in Forbes that goes back to 2004. They were positive heading in. Market went up. 2008, they were negative. We were in a bear market. Market continued to decline. 2012, they were positive, and second re-election of Obama. And 2016, ahead of Trump's election, they were positive again. So you can look back at this article. In this email, I talked about how the weekly AD lines were positive. In the middle of October, they favored a higher stock market after the election. They didn't tell you who was. The video that I talked about in that email is available on YouTube, the Viper Report YouTube page. And it's a pretty good discussion. This is the tail end of it on how I take you through the progression of AD charts to see how we went from, a pullback here in the latter part of October into early November, and then things turned around as this chart was put together. I talk a lot about my articles in Forbes. If you ever want to find them all, you can just Google Forbes Tom Aspray. You'll come to this screen, you hit on that, and you'll see all the latest articles, plus an archive that goes back to 5-8 years or so. So the last 3 weeks, I've been kind of, getting worried. I thought the market was stretched. I was wondering 3 weeks ago, will the earnings meet the market's expectations? Stock prices have been really high, and you really don't have a lot of data on what the earnings are going to be like fourth quarter or the first quarter of 2021. The earnings, we have some signs now that the economy is starting to stall. I've seen lots of signs people are complacent. Tell me that they don't need to understand the market because stocks only go up. So that's often the talk you see before, a sharp correction. We saw that in January and February of 2020, though technically the market doesn't look the same as it did then. Last weekend, I talked about a survey of money managers and the 3 things they were worried about in 2021. Quite a bit of the article is based on this article in Bloomberg, and it was based on a BofA, Bank of America Securities. They do a monthly survey, 217 fund managers that oversee $596 billion, and shows you what they're saying and what they feel about the market. Sometimes, most of the time, they're a contrary indicator when they get to extremes, but you have to look at the market too. This is one of their biggest concerns. Disappointment with the COVID-19 vaccine rollout. We're already starting to see that, unfortunately. A tantrum in the bond market. This means that maybe the Fed will cut back their bond purchases. They meet in about 20 minutes, so we'll know. I would find it very strange they would do something this time, but you never know. And a bubble on Wall Street. Well, GameStop is making more people think about a bubble. One of the things that caught my eye was the high bullishness on the emerging markets, the highest ever going back to 2004. And they don't have a really great track record. This peak right here was in the end of 2017, early 2018. The emerging markets had a crazy correction that lasted into August. I think it was about 20% or more, and that cleaned everyone out of the emerging markets. So as I said, oftentimes they're wrong. This was an article from June 13th of 2017. They were worried that the stock market was too high and too expensive. 44% of them thought that, and most undervalued market in the country. This is where that report came out here, about June 13th. We corrected a little bit into early July, and then gained about through the end of the year. So it wasn't a very good idea not to be in the market and follow that article. Stocks may try to rebound in the close. Most of the lows were made in the first hour or so of trading, so it's possible that was just a one-day off. But still, I think it's not the time to be seriously long the market. I've been not recommending a lot of new long positions the last week or two, and I think you got to be very selective and really manage the risk. So if you'd like specific advice on the markets, you can go to the newly designed Viper report. I think it looks pretty good. Viper ETF, hot stocks, give you information on how to sign up and pay for those via PayPal. $34.95 a month, you probably know that. In addition, the special offer I made for Wealth 365 traders last week. Thank you all for those of you who showed up. We had almost 1,000 people watching my presentation, and got lots of very nice feedback from it. And I'm still running the special offer if you want to get a little more involved in technical analysis and want to learn. It's a one-on-one 90 minutes for $199. And somebody in my office took this picture of my cat who was watching my presentation. Apparently liked seeing the cursor move around. This was like 2015. The QQQs made an unsupported high, bearish divergence on the AD line, but then went sideways for about a month before this huge drop on August 24th. So looks like the kitty likes technical analysis, so I may have a new pupil in store. Well, that's all I have for today. I'll keep you posted, and of course follow me on Twitter because I update my analysis usually at least once a day, if not twice a day. Hope you found this information beneficial. Thanks.